But thank you everyone for joining our Lunch and Learn session today. My name is Cassie Sauer and I'm Marketing and Events Manager for the Entrepreneurship Centre. So we're really here to support any kind of venture creation, thought processing, design thinking that you'd like to do. So if you do have any questions about that, please do reach out and get in contact with us. I will be putting all of our contact information in the chat as well. But I'd now like to introduce Dr. Shelley Brown, who will be hosting our session today on demystifying venture capital. So over to you, Shelley.
Perfect. So hi everyone, as Cassie's bringing up the PowerPoint, you saw my bio. So about 20 odd years experience across a number of companies, mainly in a venture build CEO role in startups and also within new builds within FTSE listed companies, notably Johnson Matthey and BP. In the last couple of years at BP, I was in the Launchpad and Ventures business, so I have quite a lot of experience in more strategic VC venture capital, but more recently I've joined a pre-seed VC fund in London. So when I recently reached out to the TTO in St Andrews, we've had some conversations around potential opportunities, and they asked if I could come on to this Lunch and Learn, which I'm delighted to be at, and share some insights around demystifying venture capital. So without further ado, Cassie, I think we'll just kick off.
Yep. Can everyone see? Can you see the slides okay, Shelley?
I can see the slides, thank you.
Perfect, yep. Just give me a wave whenever you want to move them on.
Perfect, thank you. So if you can go past the first slide, that'd be great, thank you. Yeah, so the purpose today, I've got about 10 slides. I'll just give you a sense of what venture capital is, and I try to put this through the lens of if you're thinking about starting a company at a very early stage. So the first slide is really just to give you a sense, basically a structure of how venture capital works, and then some of the vocabulary, which I think might be new to some people and not so new to others. So if you focus on the left-hand side of the slide, this is at the highest level how venture capital is actually structured. So in the middle, we have the venture capital firm, and some of the terminology you might hear is something called GPs. So venture capital firm have general partners. They manage the actual firm. Underneath them, there'll be a team, typically a small team of typically around 10 people, and they'll be quite senior, like managing directors and portfolio managers, all the way through to aspiring venture capitalists who can be investment managers, venture partners, associates, and analysts. So when you approach a venture capital firm, that is the tiering system that you'll actually engage. And how we actually function is that a VC firm will actually have funds. So if it's a new firm, they might be on their first fund. It might be quite small in nature. So for example, Zinc's first fund was 3 million in 2017. Funds tend to be 10 years in length, but they can be different, and they tend to be multi-million in size. And as you operate as a venture capital firm, you're trying to get proof points, and you're trying to get typically subsequently larger and larger funds. So for example, at Zinc, we're onto our second fund. That was 30 million in size, so 10 million, 10 multiple uplift. And we've had that been operating that for several years. And we try to actually make sure that we deploy the fund within 4 years. Other funds try to do it in 3, because we actually have to get a return on that money within a 10-year period. So what you'll actually also hear is something called limited partners. So just like startups go look for money, like venture capital firms, we have to raise money for our funds as well. So we have to go out and manage what we call limited partners. So each time we raise a fund, we have to get people who believe in us to invest in it. So the biggest investor in both our funds, particularly the second one, has been the British Business Bank, but we have a number of limited partners who've invested in both funds. So they put in a certain amount of money, which is the orange line here, and the reason they do this is because they obviously want a return. They want outsized returns, so they want a multiple back of at least three to 4, which is what we tend to aim for. And the way that we manage this is that out of the money that we raise for each fund, we capture a management fee. I won't tell you what that is, but it's very low single digits. That's why the teams are quite small. And the way that venture capitalists make money is that we hope to, by investing that money in the fund into what we call portfolio companies, which are startups, we hope that they will, over this lifespan of our investment, actually return to the fund And we hope that, at a minimum, we return the money that we take for the LPs and then some, and everything net above what we originally raised, we have a right to take a percentage of in what we call carry. So that is how venture capitalists are incentivized. But on the right-hand side, just some more definitional things about venture capital is. So if you're thinking about starting a business, already have a business, not everything is suitable for venture capital per se. So you can raise money from banks, private investors, debt. Venture capital is very, very specific, particularly for innovative businesses where you see a very strong growth potential. And what you'll hear me talk about is, of course, venture capital invests money, but we refer to that as capital. In exchange for that, we always look for equity and for some level of control. And that's typically exercised through board participation, but also through a shareholders agreement. The instrument by which we invest is typically through two means. So if you're very early stage and we struggle to actually come to some sort of valuation, we'll go via a convertible loan note. You might hear some people call a version that a SAFE. So that would be money in. We don't take any shares at that point. It's in the form of debt. And when you have some sort of a trigger, then it will convert to equity, or you pay the money back. Or if you're a little bit further along and we feel like we can actually value the company, then we can do direct, what we call priced investments. Two very different motivations, just from experience. Priced investments or rounds, they're much more rigorous. The legal obligations are more intense, and the governance that subsequently transpires is much more intense, and you shouldn't do that unless you're really ready for it. The other thing about venture capital is that when you come to somebody like us, we are stage dependent. So, for example, Zinc is a pre-seed investor. When I was at BP, they did seed through to Series D+. So depending on where you are in your investment cycle, so on your maturity, you will go to different types of VC funds. And then the other thing to watch out for is that VCs invest within a certain investment thesis. So for example, Zinc, we invest within deep tech, environment, and health, but there are other VCs out there that are specialists, for example, in fintech, among other areas, right? So if you have a company and you're looking to raise venture capital, you have to do your homework around what are the investment theses, so you don't waste your time. Also, something to watch out for is that when venture capital firms raise money from limited partners, they will have agreements about what they cannot invest in. So you might want to check that out early. So for example, in Zinc, we are an impact investor. So in our agreements with LPs, we can't invest in anything to do with oil and gas, as an example. I've already mentioned that we do try to return the funds and then some within 10 years, but that means that we have to actually deploy within the first 3 to 4 years. And you'll hear this often, that VCs take a portfolio approach. So every company that comes to the door, we have to assess their scalability, and we always talk about if they're venture scalable or venture backable. So every company that comes through, we have to believe that within a reasonable period of time, they'll get to a revenue of 100 million on a comparable to 1 billion. But the reality is only a very small minority do, right? So we will make an X number of investments and hope to God that like 2 to 3 will actually make it. And then just to give you a sense of how difficult it is, so often academics talk to me about how difficult SMART grants are. VCs, we look at thousands of companies a year, and we will invest in less than 10. So the ability to raise from VCs, it's less than 1% chance that you will get investment. So just keep in mind that it's highly competitive. Thanks, Cassidy. So moving away from the mechanics of venture capital and perhaps putting your lens on this, how do you think about commercializing IP? And this is where we play, and maybe just some insights, right? So whenever I approach a business that's spinning out of a university or individuals just spinning out of companies, we always focus first and foremost on the IP. And there's 3 really simple questions, right? So which I find entrepreneurs find really difficult to answer is fundamentally, what is the IP? So is it patentable? Is it know-how? Is it trade secrets? And is it novel? So we always ask to see search report. My advice is that if you are coming out of St Andrews or equivalent, always start with your TTO. They're always a very helpful place. If you're outside of the university, you can use various resources. So we see people using PatSnap, for example. They do very good searches. or you will have to go to some sort of IP specialist, typically a firm. And just to note that UKRI, also Scottish Enterprise, provide about 6,000 K worth of funding to help kickstart your searches and IP, which is also always really helpful, but takes time to actually apply for. So if you're planning to do this, do it sooner rather than later. So if you do have IP, then the next question when we would approach you would be about who owns it. Again, this is something which we find entrepreneurs really struggle to answer. And it's something in the most recent investments that I have done, it's taken longer to agree the licensing agreement rather than the actual legals. So, it has taken months. So if you are thinking to raise venture capital, I'd really advise you sooner or later and we are seeing this trend in the market that universities in particular are really sharpening up on licensing agreements. So earlier rather than later, make sure you do your IP audit with your TTO and, be really careful about the terms. So some of the things that we look for example, are your rights, because that's going to really impact on your ability to, valorize your technology, but also to get subsequent investment. So be very careful on exclusive and non-exclusive. So we always have a strong preference for exclusive rights. We also take a very careful use of field of use and geographical scope. Royalty rate, again, has to be based on something that's credible in the market and benchmarked. It has to be low, like really low, to make any sense. The term of the agreement, and then we also take a really close look at grant back obligations. So we see quite a lot of agreements where whatever you invent going forward gets them automatically granted back, and then you've got no control over to whom it's licensed to subsequently. So my advice to anyone on the phone that is in this space at the moment is go early on auditing and agreeing who owns what, background and foreground, and get some support and advice potentially from a venture capitalist so you get the right terms to set you up success. And then the third point on IP I just want to mention is it valuable? So it's probably worth noting that more than 90% of the IP generated in the UK remains dormant and stranded, which is a real pity. But the first thing we ask when you come through the door at Zinc VC is like, why do you have to actually set up a startup? Nearly everything that we see should simply be licensed to a third party or a corporate. So the first piece of analysis we ask you to do is like, why don't you simply license this, right? So you have to be prepared and work with your TTO to be able to agree that. And if it makes sense to do a startup, the first question that we ask you is really about defensibility. And then, from that point on, all you have essentially is a good idea and maybe some IP. You actually have to build an investable business proposition, right? So different TTOs do this in a different way. My advice to you is always start with your TTO, but there are a lot of programs out there. We run a venture builder, for example, which I'll discuss later, but there's lots of third-party venture builders, incubators, accelerators, studios that can help you, that provide a lot of, I would say, additional value add potentially to your TTO, and that can help you go from having an idea, having enthusiasm, having IP, but actually getting to a position where you can become investable by a venture capital firm. Thanks, Cassidy. So it's a bit text heavy, but I'm mindful that these slides are going to afterwards, so I thought this might be helpful for you to see. So like every day, like we get inbound, every day we're on the road trying to source investment opportunities. And so I thought it'd be worthwhile giving a sense of what we look for, because rarely anything that gets submitted actually ticks the boxes. And honestly, we don't have time to look at things more than once, right? So try and get this right the first time. So in terms of what you have to prepare to approach investors, preferably you want to be coming to myself or anyone in the industry via referral. For example, I know Keith and Cassidy quite well now. Ideally, if they've got something coming out of St Andrews, I'd expect them to actually drop me an email. I will do that. Whereas if you submit it to me inbound via our web portal, it goes through another system where it might not even get to me, right? So if you can, make sure that you are actively engaging and trying to get referrals through people who know people within venture capital, right? It really helps you to actually get on the radar. And then what you need to have prepared is either a very high level investment memo, 2 pages max, and there's lots of examples online on how to do that, or a pitch deck. And again, there's lots of examples online. But the second column here gives you a sense of what we need to see, right? So And just be clear, nearly every startup that comes to me, an entrepreneur, wants to sign NDA. We don't sign NDAs. VCs rarely ever sign NDAs, right? So if there's one thing you take away from this lesson today, please hear that. We only do it at the very final step of a process that's many months down the line, right? So you have to be really careful that you don't disclose something that you don't want to disclose, right? So the things that we look for, so this is literally the list that we'll go through. So team, we always start with team. So you have to let us know in your IM or your pitch deck who the founders are, the first hires are, your advisors. What we're looking to assess you on is what we call like right to play. So for example, we get a lot of people come through who've built wind farms and then suddenly they want to build a health app. Like in that situation, you know, because they've had an illness in the family and they're really sad about it. That's nice, but your right to play is pretty low. So that doesn't mean you can't move between verticals in life, but you know, we are looking to back founders who have some sort of right to play, some sort of hook that makes us believe that they're going to be able to navigate commercially their industry. In addition to that, we like to assess whether or not you have the ability to attract talent, because it's not all about you, it's about the people you can attract to you. So we will be looking to see what is the quality. Are you attracting PhDs? Are you attracting really credible advisors? So you keep these things in mind. I get a lot of entrepreneurs turn up and they're like, yeah, I've got this mate who I play soccer with, who's agreed to be an advisor, or I've got this mate who I did a PhD with and I think they're going to be like just a fab CTO. It's just not really compelling. So a lot of entrepreneurs at that age or that stage give away lots of equity. So you have to be really, really careful about who you bring on board, how that is perceived, how it's helpful, and also protect your equity. The second is around technology. So we've got to be really clear on what it is. Often we walk away from conversations going, we have no idea what that person's developing. So you have to dumb it down. Most investors don't have technology backgrounds, so you have to make it super simple. We always talk in terms of TRL levels. So please come in with a view as to what your TRL actually is, and please look it up, because I have a lot of people come in who are pre-POC and will just say it's a TRL 6 or 7, assume that we're idiots, like we're not. So be really honest actually about what your TRL level is. And then we always look for slides about competitive advantage. And again, the other watch out here is like every pack we see will have your technology and 4 or 5 other competitors, and you'll pick the metrics so you're all ticks and everyone else isn't. Like, be honest, like there's some things your technology can't do. So you want us to like think that you're credible and have thought about where the gaps are, right? So don't design the competitive advantage slide so it's just all ticks for your technology, right? It's nothing more off-putting. And then we also look for things around key risks. So we look for you to have a slide in that is really clear that you understand the challenges ahead to get to scale. Briefly, so I'm going to take you along this market. Really clear, you know, we always have a look out for techie people to make sure that they just haven't developed technology in search of a problem. We like you to be problem led. So be really clear about what pain point you're solving for and how you've actually proven that with customers. There's various ways to do that I've listed here, but also we like to get a sense of like what are you trying to build and what's the size of the opportunity. So we always look for markets that are large, like typically, you know, the total is TAM, it's called total addressable market, at more than $1 billion is ideal. But also we always test about how you want to actually capture that market. So we're mainly looking at people to say, look, are you really up for building a substantial venture scale business? And then we always test about how you're going to get there. So we get a lot of people come through and say, I'm going to build a gigafactory, I'm going to be asset heavy, I'm going to do everything on the planet, I'm going to do it in 10 countries at once. It's not really credible. We like to hear credible plans where you have considered licensing at some point. You know, you really considerate about like how much money you need to raise to actually capture the market. And by the way, if you've got a really great idea and the market size is 100 million, you're never going to get venture capital, because you have to win 100% of the market to actually win, right? So make sure you're developing something which is truly scalable. It's sensible the way you're going to scale and the size opportunities there. And the last point here is, people rarely put this in. Please make sure you consider about what the ask is. So you obviously come into a venture capitalist to raise money. You should have a sense as to how much, and then you really need to detail how you're going to use the money. So very briefly, once you've got that through to us, that is literally like the top down how we assess it. And then if that interests us, we will typically, you'll receive an email from us asking for more information, and venture capitalists always will then ask to see your cap table, which is a capitalization table, and this is where things get ugly. So your capitalization table is essentially who owns what in the business. So if you're a sole owner, you've got 100% of the capital. If you're coming out of university, they'll typically have some equity. The reason we look for this is venture capital, each time you raise money, there's a pretty standard formulation about how you're actually going to be diluted. So as a general rule of thumb, you should actually be diluted about 20% at pre-seed, 20% at seed, and the founding team should have about 50% between them going into Series A with some space for ESOP, right? So the reason I'm emphasizing this is if you come in with a cap table where, as the founders, you're already down at 50% at pre-seed, you can't raise, in our view, because the way financial VCs work, they'll view your cap table as broken, and there's just no space on the cap to actually bring anyone else in. Oh, sorry, someone's moved the slides. It's Cassie, it's one back.
Oh, sorry, so sorry, Shelley. Hold on, it seems to have skipped ahead. Let's have a look. There we go. Apologies.
All right. And then the last step, right? So if that's the cap table, which, guys, the other thing that you have to be aware of is what we call debt equity. We will always look at a cap table, and if you're at pre-seed, everybody has to be actively contributing to it. So some of the watch outs for us, particularly coming out of universities, is typically at some places, universities will take 40 to 50% of the equity, game over. There can be professors on there who've been involved in the technology development but no longer involved that take 20 to 30%. Just as a guide, VC will want that to be low single digits. So there's a lot of work that tends to have to go into making the cap table work, particularly out of spin outs, not because we're greedy, but we're trying to set you up for the dilution yet to come. And if it looks too messy too early on, then we just don't bother. So actually some VCs, if the cap table is really ugly, won't talk to you any further, right? So it's something you have to be really mindful of. And the last thing is, if you've convinced us at that point and we think the cap table is reasonable, then we'll do an introductory call. My only advice is don't turn up, expect a pitch. At that point, we'll have read everything that you've provided. We look for people to turn up and actually have a genuine conversation, because what we're actually at that point trying to assess is, in person, can we get excited about you, right? So at that point, where people tend to fall over is they don't listen, they don't present as coachable, and then we're always at this point testing for commitment and conviction. So often people fall over because they walk through the door and they're desperate to start a company, but they don't want to leave academia. Game over. If you can't be 100% all in or close to 100% in, why should we invest, right? So the last point I'll make is co-founders. So we just from experience, we like teams to be more than one. We don't invest in sole founders, most people don't. So you have to be pragmatic about the fact that it needs to be at least two co-founders or a founder with a really good strong hire. And also we test very early on for founder equity split. So it's not unusual for most VCs to expect founder equity to be split equally, mainly because most of the value is yet to be created. We often find people come in and they're like, well, we invented the tech, we're going to take 90 and we're going to give the commercial guy 10. You won't get the right commercial person and they won't be properly incentivized, they won't stick around, right? And also we have a very long conversation about the reality about who should be the CEO. Hopefully that's helpful. Next slide, Cassidy. So the next slides aren't particularly text heavy, but I thought I'd give you the whole list of questions that we find really annoying to answer, but you should ask. So the first one is, and some watch outs for you, right? So are you deploying capital? Just to watch out for everyone on the phone that quite a lot of VCs will go out, spend a lot of your time diligencing you, getting your hopes up. They actually don't have a fund, or they don't have a fund which they're deploying from. So the first question you need to ask before you put your valuable time into engaging in depth with a VC is actually, are you deploying capital? And it's quite a trend at the moment that people aren't. Just to be clear, Zinc is. You should also be asking which fund they'll be deploying from, and also ask to what degree have they deployed to date and when is the window closing for investment. So we get quite a lot of entrepreneurs come in and say, oh, yeah, we'd like investment, but we're just going to wait 8 months. And I'm like, well, that's it, like we're out, right? So they can be a bit shocked about just the reality of the deployment windows for the VCs. Always check really early on about what's your investment thesis. Also check if this is opportunities within thesis. That's pretty much a hurdle which can be difficult for younger members of VCs to get over with their GPs. And then check really on, don't be scared to ask really early on about what is the VC ticket size. So for example, at Zinc, the maximum we can invest for pre-seed is 250K, that's non-negotiable. So some it will be 500, some will be 1 million. For some individuals, for some startups, they wait to see what the valuation will be. Most early stage VCs have valuation caps, so you can just ask that, so you don't waste anyone's time. Something that's really a trend in the industry at the moment is people will charge fees. So they'll commit to putting in 150K, for example, but then they'll charge back 60K in fees in order to like diligence you, all these other things. So please be careful, read the fine print on fees. And then you need to be really careful, ask about special investment terms. So most VCs will have limitations from the LPs about where businesses have to be headquartered, the ability to deploy before the round is filled, etc. And then if the investment instrument is a convertible loan note, just ask what the trigger conditions are. There'll be something. There'll often be a long stop. So just be really clear about the conditions. I've seen businesses go under because of CLNs that were drafted very poorly. And what's really hot in the industry in the last few years, that will get even bigger under the new government, is SCIS, EIS funds. This is where either as individuals or groups of individuals can qualify for tax benefits by investing into startups. You should ask this. If you're setting up your startup, you should definitely do the paperwork to qualify for that type of investment. You also need to ask VCs if they lead rounds. Some do, some don't. Also, you should be asking if they follow on. That means if they make the first initial investment to hold their position on the cap table, which they call pro rata, are they prepared to put more money in the next round, which can be helpful for you. Also, it's not just money. You should be trying to get value from your venture capitalists. So you should be asking, if they do invest, who would sit on your board? You should meet that individual. You should get commitment on that. That will be the person in your term sheet. And you have to be, get confidence that they will actually bring value to the board. Check if the investment fits in your portfolio. So if you've got a VC that's been running for a number of years, they will have a number of investments in their investment thesis. If yours is very similar, you want to something they already have, you want to understand if it's a conflict. Also, you need to ask, how can you support with our growth plan? So VC should be bringing investor contact, network skills, and expertise. If it's a very young VC and it's their first fund, you need to just check to see what the value add. And the last one is probably the most important question: is what is your investment process? So I think sometimes people get a little bit shocked about just how challenging it is to go through a VC investment process, which I'll tell you about in a second. Ask up front so you can know where you're at and so you can plan for your cash burn. Thanks, Cassidy. Next slide, Cassidy. Thanks, Kay. Right, so what happens behind the scenes at VC? So on the left, you can see what is the activity set. So what we do, I'm not going to go into a lot of detail on this, but you can see that we do things daily at the deal level, the fund level, and the firm level. So the high level takeaway is, venture capitalists are generally extremely busy. So it's important that when you engage that you're prepared. And then I just want to talk to you about how we progress things along a pipeline. So each VC will have a pipeline that you review at least once a week as a team. And what you have to understand is that VCs really want to have velocity in our pipeline because we want to back the right founders, right? So I think you have to understand that if somebody comes to you and they will be your investment lead, they will navigate you through this process, but they're not the decision maker. So you have to work really closely with the investment lead so that at each time they go in front of the general partners of the fund and they review the pipeline, they have to see progress, they have to see the building of conviction, they need to see continuous progress, right? Otherwise that you'll be dropped. It's really important that through this whole process that the VC is building conviction in you, you're building conviction in them, and then you have to be really active on making sure that beyond your investment lead, you're starting to build relationships and buy-in from other peoples at the VC fund, right? So if you've only met one person from the VC that you're talking to at the moment, it's not going well. Like if it's going well, like they would have introduced you to the general partners, they would have brought you into the firm, they would have, socialized you, right? Because that's a big part of the actual decision-making process. So make sure that you're keeping an eye on that and actually actively requesting that. Just so you know, behind the scenes, like you write an investment memo, you write a pitch deck, you provide a whole heap of information to the VC, but your investment lead is actually in the background writing a huge number of detailed documents as part of their due diligence. This is really to motivate the investment. So that typically starts out in the form of an investment memorandum. And as you progress, that becomes more and more detailed until you get to the point where you will receive a term sheet and hopefully go through to completion. These documents that the VC firm develops goes in front of what they call an investment committee. So that will be, again, you should be asking about, what is the timeline to the investment committee? They're the ones that are decision makers. And just like I said, the pipeline is, reviewed weekly. If you go quiet, so sometimes founders go quiet, they ghost you for a few weeks. If that pops up, we drop you, right? And you might have really good reasons for that, but make sure you manage the relationship so that you don't get dropped from the pipeline, because when you're out, you're out. Next one, Cassidy. So I just want to say, okay, so if you're at this point and you've managed to get a venture capitalist interested, what next? So you've sent your forms in, you've had an introductory call, we've drafted an IM. What we will do is go away and we then make a decision to invest in time. So we do what we call desk research. We typically contact industry specialists to validate your claims. We'll also interact with them more to get more information about you and the team. We'll typically do a site visit, which is what I'm doing today. I'm in a different site today visiting a team. And we also look to speak to advisors and customers. And we're doing this because we have to write an IM that goes to the general partners. So the three basic buckets that you can expect to happen if things are heating up and it looks like there might be some alignment is that you will be asked to meet with the general partners and do a management presentation. Heading into that, you need to have your data room ready. So I get surprised by how many accelerators across the UK tell me they have to educate founders on what a data room is. It's really critical. I'm happy to provide feedback to anyone who reaches out to me about it, but it's quite a rigorous room which covers off a whole heap of legals, IP, team, etc. You can get some guidance online, but something which does take time. So make sure that you're working on that sooner rather than later and it's done to a high standard. If the GP is getting excited in you, right, then we'll actually finish drafting the IM. We will take that to investment committee and we will develop what we call a term sheet. So that will come to you. It's typically 2 to 3 pages. It's quite legal in nature, but it pretty much say, how much money we want to give, what's the valuation, what's the price per share. We'll talk all about, our expectations around the deal, dilution clauses, preference clauses, expectations around the board, what we need to see in order to get to completion. And also have appended to a cap table, so it will give a view as to what we think the current cap table is and also what we need the cap table to become. And at that point, if you countersign, if we sign off, then we're off to the races, right? So VCs expect you to actually cover the cost to do the legals to actually come to completion on a deal. So to give you a sense, that can be anywhere between £10,000 to £15,000. As a guidance, Zinc, we allow 10,000 of our investment to be used to do that. To make it simpler for you, we actually provide boilerplate legals, and we also provide recommendations for lawyers to act on your behalf. And then you're in your legals, right? So if you're a priced round, you'll get a shareholder agreement, a draft articles, disclosures, board resolutions, all the associated ancillaries. All you need to take away from that list of horrific documents is that you need a lawyer, and they cost a lot of money. And it takes time. So legal documentation with a little bit of negotiation, all going well, can take 4 to 5 weeks. not going well, it can take months. I've seen it take 18 months for Series A before. It's a lot of work. It's a lot of iterations. But if you get to the end of it, funds will be released and then all parties have completed. Thanks, Cassie. So I'll just give you a moment to think about how long that takes, and I'll actually tell you the answer. So just take 10 seconds to think about, based on what I just told you, how long you think when you should start to do a raise. And Cassie, if you can just release. So I think this always shocks entrepreneurs. We run a venture builder accelerator program at the moment in the market, if from start to finish, so from starting to warm up to your investors, to doing a roadshow, to doing diligence, to getting to a term sheet, to getting to completion, it's on average 6 months. So you can imagine that's actually quite a lot of time. So get started early, and it's important for startups because you tend to have very little money. And pretty much as soon as we do an investment in pre-seed, 3 months later, we're already starting a seed raise, right? So you're pretty much constantly raising in a startup, and it takes a really long time to do. Also, it's worthwhile knowing that that is 6 months of VC time. That's why we're trying to educate people on the process, because it has to go well, otherwise we just don't make the investment in time. Cassidy, thanks. So post-investment, so I have to tell you, at the point of completion, everybody wants to just have a really stiff drink and face plant. But the reality is that's when things get real. So this is when we get into venture build mode, and this is where the emphasis should be. So what you can expect to happen day one post-investment is that the VC firm will at least take a board seat and a board observer seat. They will straight away be hassling you to get a formal announcement out, because that makes you look good and them look good. There will be a massive step up in governance. So suddenly you'll have delegations, you'll have consents, you start to have to actually formalize. Typically, VCs for early stage will ask for monthly board meetings with proper pre-read, which can be difficult for people to get used to. There'll be an assistance in the first month to get a development plan in place that's at least 18 months in duration, and also there'll be an investment strategy. And then what you're expected to do if the CEO or CTO is to execute on the plan. But straight away, we're expecting you to start warming up for the next raise. So that, getting ready for your seed raise. So, one of the big takeaways from today is if you want to build a venture backable business, particularly if you want to be a CEO, your life is going to be about raising money. Most people don't get that. So you have to be prepared to do that. It's a lot of time on the road. It's a lot of punches in the face. It's really, really hard. And you have to really want to do it. But it also means that's why we insist on co-founding teams, or teams in general, because somebody needs to be back actually building the business as while you're out on the road raising money. We do expect whatever money we put in, you have to unlock non-dilutive funds. So that's an expectation. And then always the venture capitalists, we don't want to have a down round or flat rounds. So it's important that you deliver against the plan, because we expect your evaluation to go up round on round. And the last thing, and most people don't anticipate this, is that we expect, by this point when we're, pretty much working hand in glove or fist in glove, whatever, together, is that we expect it's not just a one-way relationship. We expect the startup to support the VC firm. So you will need to budget time to participate in showcase events for the VC, act as a portfolio reference for other founders. We will bring you in for investment committees to be an external expert, and on request interact with our limited partners. Cassidy. So I just wanted to finish off with 2 slides. One is just give you a sense of what I look for in a founder. It's a bit of a gut feel sometimes based on my own experience as a founder, but particularly in the environmental space where we're looking to build venture backable business, the most important factors to success is to understand that the true value is time and the pressure of time, but also understand the challenges of risk scale, and that you're in an environment with huge uncertainty and complexity. So the way I assessed founders, if you just press the next button, Cassidy, is first of all, you don't waste time. You understand the value of time. So if people present as just not understand the value of time, I always move on. Cassidy. The best founders, particularly in my experience in the environment, businesses are always extremely rigorous, detailed oriented, and really have huge respect for risk management. So they'll come through the door and they understand where all the risks are, and they've got a plan day in, day out, hour by hour to try and address those risks, particularly at the interface between their business and the customer. Cassidy. Sorry. The other thing is scale. So there has to be an understanding that to have impact, you need to get to serious scale. And you need to be really understanding of how to get there. So we're always testing to make sure people just don't want to build a little laboratory or a little SME somewhere, out in the back of beyond. Like, we're talking multi-country, huge scale in order to be venture backable. Cassidy. And then I can't begin to emphasize just the complexity of the global environments these businesses need to scale within. So we're always looking for people who really always seek to simplify, but more importantly, prioritize. And when you've got a venture capitalist on the board, they really focus on that. And to make sure that you really cut through this transparently with your stakeholders. And the last thing on the left here is that the people that I see do really well at this are people who, if you're just a normal person, you'd look at this challenge and you would just run for the hills. The people that are really good at this actually take a deep breath, stand still and observe, but they also really prioritize the importance of resilience. So they understand not to sprint a marathon, and they understand that they have to attract excellent people around them and actually build teams. Cassidy. I won't spend any time on this other than to say that with the slides that are out, you can take a look at what Zinc VC does. You have my email there, so you can reach out to me with any questions. But just to highlight that Zinc is a little unusual, that we run both a venture builder and we're a pre-seed investor, so we straddle both. There's a lot of venture builders out there. I've highlighted the points of difference for Zinc, but if there's any interest in following up, just give me an email. Kathy, thanks.
Thank you so much, Shelley. I really appreciate that. And I hope everyone found it super interesting. We have got some time left, so if anyone has any questions, feel free to either pop them in the chat or unmute yourself, and we can go around and do some questions. Oh, yep. Alexander, do you want to go first?
Thanks, Kirsty. Hello, everyone. Hi, Shelley. Thanks for that. That was great. I'm one of those lawyers that you were talking about, but thankfully not.
Oh yeah, Alexander.
I'm
we need to talk.
Really expensive, and hopefully a very pleasant experience going direct. You picked up on so much in that slide deck. It takes quite a bit of unpacking still. So
Sorry, Alexander, you're a bit quiet.
Sorry,
there we go.
Can you hear me now? I've got my microphone up here.
There we go.
So just saying, so I'm one of those the corporate lawyers that sort of do these things. So I see quite a lot of these deals, and something I'd seen recently and would be really interested in your thoughts on this, Shelley, is founders being encouraged to create a sense of a fear of missing out, and it might be one that isn't necessarily very genuine. And I'm starting to see some of the VCs and investors out there saying, we know it's bullshit, and and it's actually pretty off-putting. So if you're out there doing that, is it a genuine sense of momentum you've got, or are you kind of sort of being a bit misleading? What are you seeing?
Yes, we have this, we have a lot of whiteboards at Zinc with phrases we hear all the time, which make it just completely nauseating. One of them is FOMO, right? So Alex, it's definitely a trend where people come out and they try to paint a picture where you're going to miss out, you have to do this, they try to pressure us into engage. It's really off-putting, to be honest. I think maybe some VCs fall for it. Certainly at Zinc, we've actually hired in people who are specialists in the areas. So it's very hard to pull the wool over under our eyes. And it's we are always, first of all, we're always assessing if we want to work with you, right? And if you turn up, excuse my language, as a complete bullshitter, right, who's not really investing in the relationship, who's not going to be upfront and honest, who's trying to pressure me into something I don't want to do, then I don't want to work with you, right? So we do see it, Alex, a lot. So we get about 1,200 inbound requests in Zinc per month. It just gets filtered out pretty quickly, to be honest. So, it becomes really clear who's genuine and who's really somebody who's relationship driven, respectful. It stands out pretty quickly, to be honest. And the FOMO, it just doesn't work. And honestly, Alex, like the number of people that come back to us who change tact because they realize it hasn't worked. In addition to FOMO, like often they do it because they're trying to pressure us to move to a different point in the valuation. We're just like, goodbye. You're not worth it, right? So I just can't emphasize, like, there's just so much inbound, right? It's just, if you're going to play games, it stands out really quickly and it's really off-putting. So I think be authentic, be respectful, right? And that's going to be, come to a venture capitalist via referral, right? And be visionary, right? Don't be too conservative in the vision piece, but you've got to be first and foremost someone we want to work with. And the BS becomes pretty, and we don't like being pressured, right? So we also have got a good deal, and we don't send out many checks, and we'll hang out for the right person, right? So.
And on that valuation piece, just a quick follow-up question was, I saw in the slide deck there the mention of, are you $1 billion company? Is Zinc VC a parallel VC? Is it a sort of, you're not interested if the companies are going to aspire to be bought by a unicorn but may not reach unicorn valuations themselves? They may be exiting at 500 million rather than the billion mark. Is that, where does that fit in your thesis?
Yeah, no. So we say we first of all we look for aspiration. So I think it's first of all test for aspiration, and some people can actually build a business with an exit at 50 to 60 million. They'll be really happy, right? That's So first of all, we are testing for aspiration to get the return on our funds. It doesn't have to be $1 billion. It can be lower in sort of the numbers that you're talking about. So it's more about testing the scalability and the ambition. But if you're exiting at half of that, we would be pretty delighted, to be honest. So, yeah.
Thanks so much, Alexander. Apologies if I mispronounced, but Nishant, do you want to go next?
Sure thing. Hi there. Thanks so much, Shelley. I was just wondering, as someone who doesn't really have a lot of deep technical expertise, but is interested in the deep tech sector, what are the best ways that people without expertise can add value to the sector? What are the kinds of things that they can really help startups do?
Yeah, Nishant, and it's like I wouldn't underestimate like the value that you bring. I don't know about your personal impact, right? But when we build venture builders, for example, we bring in 3 types of people on, right? One is people with an investment opportunity. They're always helpful, right? They tend to be techie in nature or business model innovators. The second are people with deep domain expertise, right? So that can be coders, it can be engineers. For us, we do health as well. So it can be, I meet a lot of doctors, neuroscientists, stuff like that. And the third category, which I think is really important, is people with commercial knowledge, right? Or scaling knowledge, or anything about customer relations, market, right? And to be honest with you, it's easy to find the first 2 categories. It's not easy to find the third. So finding people to build out teams with softer skills and commercial skills and other skills, which are really critical, marketing skills that are really critical to commercialize and scale up, is really hard to find. So I would say don't be put off because you're not techie, right? There's so much that needs to be brought beyond the techie person to be successful.
And sorry, if I could just quickly follow up on that. Does it tend to look more like people who've helped cut commercial deals working at sorry, I think you lost me there, but just a quick follow-up. Would that experience look more like someone who's helped sort of help run commercial deals, and whether that's for a big corporate, helping them with sales in a particular area, or is it, would someone with a marketing background and marketing experience also be someone you guys would think, oh, this is interesting, and is a demonstration of someone who could help this business scale?
Yeah, so all of the above, right? So on our recent venture builder, we backed someone into a CEO role with a marketing background. We've had someone from a banking background. We've had somebody from a trading background. We've had people from supply chain, procurement. It's those commercialization skills. It's very rare to find someone who's done it before in the exact same industry and has, struck really big, first of a kind contracting deals, right? So it's, Nishant, it's first and foremost, you've got to match with somebody who you want to, it's like a marriage, to be honest, a founding relationship. We always see people matching based for soft skills with a view that what can they bring, and then you always hire for the gaps, right? So
Thank you so much.
you're welcome.
Tom, would you like to share your question now?
Yep. Hi, Shelley. I've been working with startups and university spin-outs for about 27 years now as a business advisor, and I work on the Innovate UK iCure program. One of the difficulties which you clearly mentioned earlier in your presentation was the amount of equity that UK universities seem to want from spin-outs, which is, as you say, between 30 and 50%. I mean, Irish universities look around 10, American universities around 6. Why are we 30 to 50%? And, it's a millstone around the neck of those young founders. And a government report last November suggested a more realistic figure was 10%. Universities in UK don't seem to be listening to this. What can be done about it?
Yeah, it's interesting, Tom, right? So good shout out to iCure, right? So I think they're a fantastic program, and it's getting revamped for next year, which I think is really powerful for spin outs and also investors. So I recently had this conversation on a panel with iCure as I thought about how we're going to reshape it, right? So I think I should maybe temper my comments along the lines as it's very university dependent, it's very regional dependent, and we're seeing a lot of movement, right? So we're seeing more in the Golden Circle, which is down south. Typically, if it's a start-up out of uni by students, they take nothing. If it's more of a, really IP-led out of many years plus heaps of IP, then we're seeing rates of around 10%, but then there'll be opportunities to take a lower amount, but it doesn't, it's non-dilutive till seed and it starts to dilute. So we're seeing the numbers get it right, but then the structures around it get complicated. And then we're seeing we're seeing some universities, for example, take a fair amount, post-investment, but they're also putting in quite a lot of money. So I'm happy. I think universities should get equity. I think it should be negotiated. So we're increasingly, off the back of that report in November, seeing quite a lot of universities around the country start to make it negotiable. And I think that's a good starting point, right? Because the reality is we're trying to train the entrepreneurs to negotiate in every element of their startup, right? So they should be encouraged to negotiate for the equity, right? And I think that, of course, increases the workload, but it forces them to behave, the entrepreneurs, in a way that we want them to behave when they go out into the real world and negotiate equity with anybody, right? So I think what they already do for negotiating on licensing should go to the equity as well. And I just see people coming from universities that have had that ability, and they get a slightly better deal, but they feel really good about it, right? As opposed to having it imposed. So I think I'm seeing a lot of movement. There was lots of parts of the country where they were taking 50%. We're seeing that improve substantially. But the other thing I'll say is quite a lot of unis are starting to put money into, which I think is really helpful. But I think it should be negotiated. Even if it's only a marginal change, I see a huge impact on the actual entrepreneurs. So.
Okay. Thanks.
To be fair to Scottish universities, I think we're not really seeing any of them doing 50% equity anymore. I think its majority is down at 15 to 20%. I think some are even looking at, on the back of things like the Bowhurst report, reducing the equity level where the spin out is very low in terms of fees, is quite lean, maybe in certain technology sectors and software. But I think we all have to acknowledge that there were facilities made available, there are patents that are registered and paid for along the way, and so the universities definitely have an interest in seeing that protected. But I'm on company side as much as the university side, so I think it's all about making sure it's a healthy ecosystem and it's investable, right? Because it ultimately nobody gets anywhere if these companies aren't investable and aren't attractive to VCs, both domestic and, very importantly, I think foreign as well, because I think there's a strong agenda to see more US venture capital coming into the UK, in particular Scotland.
It's interesting, Alex. I've lost count of the number of dinners I've gone to with TTOs that I really respect, right? And they'll say to me, we don't expect any of these companies to actually return to us anything, right? And I said, well, then set the equity at 0. Oh, no, we can't do that. It doesn't make any sense to me, right? But yeah, it's for me, it's like, it's just about setting the companies up for success. Like, you just got to have a certain headway to actually provide the space for new money to come in and dilute and keep the founders incentivized. It's as simple as that, right? And that's the argument that I struggle to land sometimes. Anyway, there you go.
Super.
Okay.
Just in the effect of time, we'll just finish up with the last 2 questions in the chat, if that is okay with you, Shelley. The first one being around looking for a summer internship at a VC firm and how best to approach them if they're not, say, maybe if they're not advertising it openly. Would that be something that would be best kind of get in touch with someone like you about, or someone else?
Yeah, absolutely. I do apologise. I'm diligencing a startup actually associated with St Andrews today, and a big truck just went past. But I won't say who. Yes, so we don't advertise for internships, but we love them. So you can imagine it's a bit of a test for us that people have to figure out a way to reach out and actually capture our attention, right? So my advice is to email me. Do your research on which VCs make sense for you, like in terms of location, investment thesis, what they're investing in, what value you could bring, what stage they're at, and then do the research on LinkedIn on some people. So I'm one person, right? But we love bringing on interns, right? Because there's just, you will get experience. Even if it's for a week or if it's for longer than that, we'll get you exposed to the pipeline, get you involved in meetings, all that sort of thing, right? So we do bring a lot in, but it's always through referral or by somebody who's really found a very clever way to get to us, right? So rarely are they actually advertised. So.
Perfect. And the last one we've got is, what total readiness level is appropriate to apply for VC funding?
That's a really good question, right? So I have a lot of people come through the door, pre-POC that don't think they can get investment. That's not correct. So pre-POC, you'd be at like TRL 2. I get very frustrated with people who decide to do 2 years worth of like government grants to move the TRL. It's for me, it's useful, but it's too slow. So my advice is first and foremost, focus on the team, focus on the market, focus on what you're trying to achieve, go have the conversations as early as possible. And we invest TRL 2 as long as we can see a route to get to POC, and we'll actually take that risk. I think it's just honestly be honest about the TRL level. Our first checks tend to be more TRL 3/4. Once they get to 6 or 7, it's a little bit too late for us, right? It's no longer pre-seed. So my advice is just don't get too obsessed with TRL level. Be honest about what it is. Be honest on the pathway, why you need money to get to where you need to get to, how to actually do that through dilutive and non-dilutive. And the last thing I'll say is, we actively hunt for really good entrepreneurs. You'll be surprised, the success rate with Zinc is very, very low. It's very low with all VCs. If a VC reaches out, take the call. I'd be surprised at how many entrepreneurs will say, I'll speak to you in 3 weeks. It's mind-blowing. It's so hard to get VC money. If there's interest there, just jump on it, because the advice, they'll put you on a list and they will mentor you until the point where you're ready for investment, right, with them or someone else. So it's also a really small community. So last thing I'll say is I'm always testing for entrepreneurial qualities. The right entrepreneurs always get on a phone call to have that call, right? They make shit happen, right? And they understand that VC is really hard to get. So my advice is not to get too hung up on TRL. Make sure you're accurate. Make sure where you're at, the pathway to get to move it, and also you have to be engaging with investors early and often. And if they ask to talk, prioritize it.
Great. Thank you so much, Shelley. I really appreciate your time, and thank you for everyone else for joining as well. I will pass on Shelley's details and slides in the next day or so. So if you do have any other questions to follow up, you will get them. I've also popped our email for the Entrepreneurship Centre in the chat there. So if you want to get in touch with us, If you have a startup idea, spin out, you want to talk, you're more than welcome to come and talk to myself, Keith, or any other members of the team. But thank you again, Dr. Shelley, and enjoy the rest of your day, everybody.